Companies can manipulate their financial statements in a variety of ways. Some of this is simple earnings management, while some of it is outright fraud. The most common way for a company to manipulate its financial statements is through improper revenue recognition. This means the company recognized too much or too little revenue. Usually it's too much. We call that aggressive revenue recognition, and they recognize a sale when they should not be recognizing a sale. It could be a completely fictitious sale where they made up shipping documents and pretended like there was an actual sale to fool the auditors, or it could be something where they convinced the customer to take product that they didn't want. So, for example, Under Armour was going to Dick's Sporting Goods and saying, hey, you should take more of our Under Armour products. And Dick's Sporting Goods was like, look, we have enough of your product. We don't need any more. And Under Armour was like, look, just take it. And if you don't sell it, you can send it back to us the next quarter. Don't worry about it. So basically, that's called channel stuffing. They're just stuffing their customers with product that they don't even need. And a lot of times they'll tell the customer, look, just send it back the next quarter and we'll pay the return shipping. So the customer's like, all right, fine. I guess if there's no cost to me, why are they doing it? They're just trying to meet their sales target for that quarter. Now, I've got a whole video that I'm going to be making on aggressive revenue recognition and all the different ways that companies do it. So right now, let's just move on. Changing the timing of events is another way to manage earnings. Here's an example. Company has an available for sale debt investment. So we've got an available for sale debt investment. The time I'm making this video in the United States, when you have an unrealized gain or a loss, unrealized gain or loss on available for sale debt investment, that just goes to other comprehensive income. It doesn't affect the company's net income. It doesn't affect their earnings. So if you have an unrealized gain, and you say, hey, I want to boost my profitability, I want my net income to go up this quarter, you could sell the available for sale debt investment. Let's say you had an unrealized gain of $1 million. You sell it, now it is a realized gain because you have sold the investment. So that $1 million then would affect the company's profit. So just you're changing the timing of an event. You weren't necessarily going to sell it now, but you need to hit that earnings target this quarter. So you say, let's sell the available for sale debt investment so we can book that $1 million of income. Now, improper capitalization, that has to do with there's some expense. Okay, there's something that's an expense, and you basically made it an asset. Okay, you made it an asset when you weren't supposed to. Okay, so an example is WorldCom. So WorldCom went bankrupt. There was a huge accounting fraud. It was around 2002. Basically, there was something called line costs. They're a telecommunications company. And these line costs, they were basically paying other telecommunication companies for the right to use their capacity to fill in gaps in their network. And these line costs should have been expensed. But what they did was they made them an asset, and then they expense it over time. So let's say we're talking about $2 billion of expenses. If you make it an asset and expense it over 20 or 30 years, now you're spreading the expense over a much longer time horizon. So you're increasing the current period net income, but decreasing the net income of future periods. Now, sometimes with property, plant, and equipment, we should be capitalizing, okay? We should be so I'm not saying you should never capitalize an expense, right? It's improper capitalization. These line costs were just something that were supposed to be expensed immediately, okay? So it'd be like if you're talking about, let's say you had a consulting company and they were paying one of their accountants and they said, let's make that an asset. And it's like, nah, that's not an asset. That'd be an SG&A expense. Okay, so now manipulating estimates would be an example. So waste management. So the garbage company, Waste Management, what they were doing was they were changing the estimates on the estimated useful life of their trucks. They were extending the useful life, and let's say the useful life had initially been 10 years. They said, let's make it 15. So they were basically increasing the estimated useful life, which would spread the depreciation over a longer time horizon and decrease the depreciation taken in the current period. They're also increasing the residual value of their trucks. So people don't understand when they get into accounting that the management has a lot of leeway in terms of estimates and also even choice of accounting methods, right? They could choose a different accounting method, switch from LIFO to FIFO, for example. If we're talking about a company, a retailer, they switch from LIFO to FIFO. FIFO generally will result in higher net income than LIFO. So manipulating estimates, choice of accounting method, managers have a lot of discretion in choosing these estimates, and they can use those estimates to make the accounting numbers look better than what they actually are. Okay, now, when it comes to altering actual business decisions, just to give you a couple examples, let's say that the company just says, let's say they normally spend $50 million a year on R&D. So you spend $50 million a year on R&D, and you come in and let's say you put me as CEO and you say increase our profit, and I say okay, we're not going to spend anything on R&D. It's zero. So now I've changed the business decision just to pretty up the financials and increase our profit. Now our profit's going to go up in the current period, but in future periods we're going to be hurting because we just got rid of all our research and development, right? We're not doing any research and development spending anymore. So it's a short-term type thinking. You take this business decision, and it might be in the it's not in the best interest of the company in the long run, but you slash R&D just to boost profit in the short run. Another thing is, if you're a manufacturer and you say, oh well, we're supposed to do maintenance. We're supposed to do maintenance on our machines. Well, that costs money. You say, you know what? Well, we're not going to do maintenance. We'll delay it. We'll delay it for a quarter or whatever, just to increase the profitability that quarter. Now, companies will also use, you really got to be careful with related party transactions. So related party would be like, let's say, so with the company Adelphia, they were a cable TV provider. And basically this Regas family, they not only ran Adelphia, they had other companies. They had other companies that they were involved with that they also ran, and so they had. You can have when you have these related party transactions, it's like the same family is like controlling not just this company but other companies, and then they can have where like let's say you can set up a company here, company B, and company. So it said like, oh, Adelphia, they sold product to company B, and it's like, well, was it really a sale? Because this person, they control both of these companies, so when they're saying like, yeah, this company really intends to buy this from Adelphia, do they intend to buy it? Like, is that legitimately a real credit sale? So you got to be careful with these related party transactions. Now, mergers and acquisitions. Whenever there's a merger, there's a lot of ways to like bury expenses and capitalize assets that or capitalize costs that shouldn't be capitalized. So there's a lot of times when there's a merger, there's some funny accounting going on, and so you got to be careful. Or you'll even have a merger where companies like booking some of the companies, so they acquire another company and they're booking some of the revenue from that company from prior to the period when they acquired them. And so there's just sketchy stuff. So not every time that there's a merger is there accounting fraud going on. I'm not trying to give that impression, but there have been a lot of times. For example, WorldCom did a lot of M&A activity and was using that to do some fraud.